was a little bit late there on the go live. Hi everybody, Lawrence here from Financial Thing for the weekly Financial Thing live stream. Yes, it is June 20th. Isn't the 21st the longest day of the year? I think it is, or the 20th. Amazing to think that we are right around the corner, or at the longest day of the year, halfway through the year. Crazy how time flies, doesn't it? And today, sad news, Donald Sutherland, the actor, has passed away at the age of 88 years old in Miami. And as one gets older, we also see people get older alongside us, people that we watched on TV or in the movies or in the films, and it's certainly a sad day. And also today, Boeing Starliner is apparently stuck in space, unable to bring back the astronauts that went up to the Space Center on that first Boeing Starliner flight. So imagine Boeing having more issues. Gosh. Anyways, thank you to everybody who's here watching today or this evening. It is a very balmy 30-something degrees here in Orlando. I long for cooler weather, but alas, at the moment, that cannot be attained for personal and work reasons. Anyway, you don't need to hear about that because you came here to hear about other stuff, more interesting stuff, so which I'm going to try to provide to you today. But I will tell you that this week has been a really slow peer-to-peer lending news week. There's just not really been a lot going on. As far as I'm aware, I don't catch everything. But I did reach out to Louis from LoanPad and offered him an invite to come back on the stream. We haven't had Louis here for a while, so hopefully that is going to happen either June or possibly next month. And also yesterday I did record a really good video with Peter Wilkins. Peter Wilkins. He is the asset manager at Cufflink. So we had a really good chat about his role over there and what exactly he does to manage the assets over at Cufflink. So I'll be uploading that to the YouTube channel soon and in the next few days. That is not going to be a live one because we didn't do it live due to schedules. So that's good. That was a really interesting video. It's not as long as the live streams, but today, or this evening, I believe, will be the first time that I tried to do a stream under 30 minutes, because honestly, I'm feeling a bit under the weather today, so forgive me. I'm going to try to keep it a little bit shorter. I hope that's okay. I got an interesting email from the mailbag a couple of weeks ago that I thought was good, and I'm going to show you what that email said. We'll do a little bit of peer-to-peer lending news and little bits of interesting bits and pieces also. So thank you to everybody who's here. Colin in the Peak District, Peter Vince in sunny, warm, hot, I presume, Leatherhead, Paul Bagworth in Kenilworth, and George is here in Bridlington, and to everybody else who's watching here now and in the future, thank you so much. Quick shout out, of course, to our sponsor of the show, Cufflink. Well, I finally fixed their graphic. It is correct now. It says earn up to 10.25% gross interest per annum. Over £330 million invested since 2016. Zero investor losses to date. Capital is at risk. Please don't invest more than you're prepared to lose, because you can lose money in peer-to-peer lending. And please check rates on Cufflink's websites as rates do change. Sign up is in the link below if you don't have an account. join.cufflink.com/financial-thing. Now we got the housekeeping out the way. Thank you again to Cufflink for sponsoring. Annabelle, hi from Spain. Yeah, I don't know if I'm not well. It's just one of those weird, I got to put the little Cufflink logo up. It's one of those weird things, right, that I don't know if it's that I'm not well, but I feel a little funky today. So the dog is here. She's sleeping as always, soaking in all of that financial information that she will never need in her lifetime. But let's get to it. Do a little bit of news and show you what's going on in the mailbag. Here we go. That is Lewis Alexander from SoMo, the United Kingdom peer-to-peer lending company. SoMo investors earned £29 million in interest at the 10-year anniversary. Property lender SoMo has celebrated its 10-year anniversary by announcing its investors have earned £29 million in interest with zero capital losses to date. It's quite impressive over 10 years, imagine. Since inception, SoMo has loaned $333 million to borrowers, while investors have earned up to 13% in returns over the past year. 90% of the new portfolio investments come from existing investors, according to a recent SoMo survey. These repeat investors told the platform they were attracted to the high yields, the opportunity to invest in a mix of fintech and people-based services, the platform's experienced recovery team, and the backing of reputable industry bodies. We had big ambitions 10 years ago, but could never have envisaged how successful the firm would be, said Louis Alexander, CEO at SoMo, who, by the way, I've reached out to Louis a couple of times, invited him to come on the stream. No answer yet. Lou, if you're watching, for some reason, come on the stream, tell us about SoMo. I'm sure people would like to know. Mr. Alexander also says, behind me is a passionate and tenacious team working hard to ensure our loyal investors continue to enjoy all of this and more as we evolve over the next decade. One thing that won't change, though, is our slow and steady wins the race strategy, which ensures the longevity of our firm and the confidence of our investors. SoMo posted a pre-tax profit of $6.2 million for the 12 months ending the 31st of March 2023, up from $5.6 million the previous year, according to documents filed with Companies House. I'm really not that familiar with SoMo. I do know people that have invested through their loans, and they're very similar to Cufflink in the size of the amount lent and also some of the interest rates that they pay. 13% is quite high, so definitely just remember there is risk when you are being paid 13%. Not everything can be rosy all the time, but I did check out their statistics page. Here it says 264 plus million lent, so a little bit different to what that news report says. They say 330. Capital loss is zero. Average return per year 10.8% and 99.7% interest paid. You can see here the annual interest earned by investors. 2022 is kind of the lowest out of the years at 9.42%, which is still pretty good. And if we look at their loans, I don't know why the loans don't show for 2023 or 24, but it stops at 2022, which, come on, SoMo, let's get those statistics updated. Average loan to value, 56%. That's pretty good. And we can see here loans still outstanding. They definitely have some from 2002 onwards outstanding. They've also got a lot of loans that have been paid in full, according to this 2022, up to 219. And then, let's see if they have any default information here. I guess this is their default arrears and repossessions. But yeah, go check out their statistics page. I think you got to be have an account with them to go look at that statistics page, because you do have to log in, which I think that should really be information that's out there for the public rather than behind a wall like that. But you can get an account there and go check out those statistics. It seems like they're doing a good job, so kudos to them. Moving on, Crowd Property News. They have hired the head of business development for London. His name is Simon Michael. He comes from London Credit, where he was an operations manager. And Crowd Property continues to add very, very experienced people to their team as they continue to develop the business and hopefully get those late loans repaid. I did take a quick look at LinkedIn at Mr. Simon Michael, because I do like to see who's behind these companies. He's got a pretty long work history of working in the banking sector. Graduated from the University of Hertfordshire. 2000, he worked for Maffin Lakey Bank in London for a couple of years. Then he was a mortgage advisor and business development manager for a bridging corporation for a pretty long time, 6 years. And then operations manager at London Credit just for 10 months before moving on to the head of business development for London and Southeast at Crowd Property. LandInvest lowers full-year profit guidance due to an accounting issue, apparently. And if somebody smarter than me and more intelligent can understand what this is talking about, LandInvest has lowered its full-year profit guidance due to an accounting discrepancy relating to the sale of its securitized loans. A specialist mortgage lender announced on the 5th of January it would earn $12.1 million from the sale of its interest in a securitization of buy-to-let mortgages, but it has now reduced its expected net operating income and profit before tax for its 2024 financial year due to an isolated issue with the accounting advice concerning the sale. The issues related to swap and hedge accounting assumptions that include mark-to-market adjustments and fair value hedge accounting. I have no idea what any of that means. I'm not an accountant, but I do know sometimes that accountants give advice as to they're trying to look forward at their numbers and figure out what exactly their profit guidance is going to be based on that advice that they're given, and sometimes accountants do change the advice that they give. So it looks like this is what has happened. It doesn't say what their expectations are going to be now, but I guess we'll find that out in the future. There was an article that I found. This is about 3 years old. Let's see when the date on this is. But it was an article about a peer-to-peer lender through RateSetter back when they were trying to pay back all of the people. And it was an article entitled, "I'm 19,050th in the queue to get my savings back." This saver was freaking out. Michelle Johnson, her name was. She signed up with RateSetter in 2019 and invested a total of £1,000. After changes at the firm in the summer, she asked to withdraw her money, but months later, and this is back again in 2019, she was still trying to get hold of the bulk of her cash. She asked The Guardian to investigate it, find out what was going on. She said she was in a queue of thousands of people to remove her money. And she said, "I'm scared I'll never see it again." It's interesting to read back on this article because this was, 2019 is now 5 years ago. But I remember those days when we were all sat in a queue. So if you wanted to withdraw money, you had that RateSetter queue, and especially when the pandemic hit in 2020, that queue got larger and larger and larger. And I can remember it's giving me memories about me doing a test withdrawal and seeing that queue number barely moving. And it's interesting to read this article and remembering those days back when RateSetter was the giant business in the peer-to-peer lending retail sector that it was. It says in the article, RateSetter told customers your money is in queue and still on loan and continues to accrue interest. And what a lot of people didn't understand when they invested in RateSetter is exactly how it worked. That in order for you to get your money back, there had to be somebody who would take, essentially putting money in to take the loans or the portions of the loans that you were exiting. And people didn't understand. A lot of people thought it was more like a bank savings account, so they didn't do their research and were surprised that they were not able to have instant liquidity on their money, especially when there was a run on the money and people started to get a little bit nervous because of all the peer-to-peer lending failures that were happening during the time. But some of these investors, I would say uneducated investors, were not really up on how the whole system worked. And so it's funny to read stories like this. And another reminder that whatever you're thinking about investing in, make sure you understand the product, and make sure you understand that in places like LoanPad or Easy Money, even though it says that the liquidity is there, that's absolutely not guaranteed. This is an investment product. Right now, liquidity is good, but it's not always guaranteed to be there. So, yeah, make sure you always remember that. This article also talks about Zopa and then Funding Circle, the big three that many of us were invested through not so many moons ago. Good memories, I would say, and some bad memories too. I think Zopa was okay. Funding Circle, not so much for me personally, but RateSetter, I was always happy with them, and the result at the end of the retail exit for them was a good one for everybody, because people got their money back, which was different to some of the other companies that failed. Anyway, moving on. I got an email. This is a good email. I always like these emails. This is on the 12th of June. The date's backwards here because it's the Americans. That's the way they write their dates. Hey, Lawrence, in your past life streams, I like that, life streams. Yes, they are sometimes about life. You've spoken a lot about Vanguard index trackers. Vandex. Oh, that's not a bad name. Vanguard index trackers. I personally have been a Fundsmith investor for the last few years, and I tend to disagree with you about buying index trackers versus actively managed funds. Can you explain why you think index trackers are better than my Fundsmith fund? Cheers, Peter in Northern Ireland. Yeah, I like disagreement emails. Disagreement emails are good because it leads me to start thinking about investing and planning and what the average person out there might do, what Joe Public might do. And so I decided to go back to the beginnings of the Trading 212 portfolio experiment. It really was an experiment back in, you can see my first video on the channel right here. This would have been in 2020, and it says my Trading 212 5,500 pound portfolio experiment, single stocks versus index tracker funds. And we were having a good time back then with some of these stocks. We got the Fastly stock that was in there. We had AT&T, we had JP Morgan, and it led me to start thinking about what if I had just bought and held these stocks from now till back then. So about a little bit less than 4 years, so 3.5 years. And for anybody that's followed this experiment, for everybody that's watched the streams for the last few years, you'll know that I got most of the investing advice, bar a couple of stocks, from this motley fool UK share advisor, a US service. I used the US at the time, but they have it in the UK. And they basically sell you a newsletter for, I can't remember how much I paid for it. I think it was about 100, 200 pounds for it. There we go, 149 pounds, 41 pence a day. And they basically send out a newsletter, and they show you what stocks they love and blah, blah, blah. And they give you these ones right here. Britvic up 397%. HomeServe up 623%. Ryan Shaw up 250%. And this is the way they get general public to buy into this stock picking service or recommendation. Now, everything that I put on the Trading 212 portfolio was never designed to be financial advice. It's more an experiment of somebody like myself who's not very experienced at picking stocks. I make a lot of mistakes. Quite famously, buying a stock that went to zero. Not many people can say they've done that, but I have. And I kind of wanted to highlight, these newsletters, first of all, to show maybe they're not the way. Problem for me is I couldn't hold on to these stocks long enough to actually long test this motley fool service, nor that, this is one of the problems with picking stocks. It becomes more of an adrenaline rush. And I don't really have the patience to sit on the stocks that they were recommending. Now, the other problem too was that their stock list was really long. I think they had 30 of their picks on there, which presents a huge problem because most people are not going to own 30 stocks. That kind of dilution doesn't make a lot of sense, and you had to have quite a lot of money, at least to be able to put any decent amount in to make it worthwhile into 30 stocks. So I was just going out and kind of picking a few off the list of what I thought might be the ones for the future. And it was a bit like throwing darts at a dartboard with your eyes closed, and a very small dartboard. I think that the stock market this year is doing very, very weird things. I mean, we're up about 15%. The S&P 500, we got news reports out there saying that a big drop is coming, of course. Always is one of the narratives out there when we're these all-time highs in the markets. So anyway, after that letter, and then thank you again, Peter in Northern Ireland. Thank you for watching the stream. But let's take a look at your Fundsmith fund. I know some people in the stream also have this fund. Fundsmith is an actively managed fund. I think Trevor, what is his name? Who owns that? Fundsmith. Fundsmith owner. Terry Smith. He's the founder of Fundsmith. He's a stock picker, and he's generally thought of as one of the better stock pickers in the UK. And what I did is I made a little slideshow here. It took me a while to do this, so that's why the stream is really about this today. But I think it's an interesting stream, so I'm going to show you what I found. And this is called Buy and Hold Stocks versus Trackers. September 2020 is when I started the 5,500 pound trading 212 portfolio, or I deposited that amount. And today we are June 2024, June 20th. And this does not include dividends, these numbers, because my brain wouldn't go to figuring all of that stuff out. It was quite complicated. So what I did was went back and looked at some of the very early stocks, some of the earliest ones that were purchased in the Trading 212 portfolio, and then figured out if I'd have held those stocks from now until today, how would the portfolio have fared about 3.5 years later. A lot of people always say buy and hold is the way to go, which is absolutely true. Buy and hold is the way to go. But when you're picking out single stocks, the problem is you don't know which stocks are the right ones to buy and hold. And I think these numbers are going to show you the realities of that and why the trackers are I think personally, the way to go for most people. So let's take a look here. Buy and hold stocks versus trackers. There's Popeye on the right. There's a guy on the left who's obviously losing all of his money at the gambling table with his scotch glass over there. Okay, here's the stocks. And by the way, this is Only Fools on Horses, because I just like Only Fools on Horses. And Del Boy's there, and he was always the man chasing after the quick get-rich scheme. So there's Del Boy. This is one of the first stocks that went into the portfolio. It was the drug AbbVie, the drug company. Again, these were all purchased in September of 2020. The purchase price of AbbVie at that time, $87 US. And today's purchase price, when I checked the stock price today, was $171. So the total possible return holding AbbVie would have been 95%. That was a score. Next, Alteryx, cloud computing company. Purchase price back then when I did it, $106.90. Today, June 20th, $48.26. So we had a 55% loss if we'd have held that stock to today from 3.5 years ago. Not a very good result. Next, Apple. There's Steve Jobs holding the original iPhone, the 3G version. No, was it the Edge version? It wasn't even 3G. Rest in peace. Purchase price of $107 $210.76 US cents, and today's price $210.67. So 95% return on Apple. Apple was kind of a no-brain purchase, one that probably should have been held, but there you go. The problem with stock picking, you don't always hang on to things. Next, AT&T, the phone company, the big US giant. Most people buy for dividends. AT&T pays a really good dividend. I think it's about 7 or 8%. And here shows you one of the problems of buying and holding dividend stocks. They don't always work well. Purchase price of that, $28.09. Today's price, $18.10, for a total possible return of 35% in the negative. So you can see there, this high-priced, this high-paying dividend stock just didn't perform well over the 3.5 years. This is why I'm not always big on dividend stocks. Aurora Cannabis, you can see Uncle Dave on the left there having a toke on some weed. $11.59 purchase price. Today's price, $5.32. So return minus 54%. So definitely not a winner on that one. That one, by the way, was not in the Motley Fool. That was one that I discovered myself that obviously did not do well. Blackline, another cloud computing company. And you'd think all of these computing companies would have done really well, but not the case. 98.06 purchase price. June 20th price today, $44.25. A return of minus 55%. Another loser. Etsy, there's Granny up in the corner knitting away for Etsy. Purchase price $115. Today's price $57.57. Another 50% loss. This is a seem to be a pattern of losing here. Again, these stocks were Motley Fool advisory stocks. Fastly, another cloud computing. We did make some good profits on Fastly, and thank goodness we got out when we did, because purchase price of $89.39 now today is sitting at $6.93. That's 92% loss. We did pretty well in Fastly by moving in and out of that stock, but a buy and hold would have absolutely been disastrous. JP Morgan, there's Scrooge McDuck, the huge banking investment company. Purchase price $111. Today's price $196.45. 77% return if we'd have bought and held. Incidentally, JP Morgan has $1.6 trillion of cash on hand. That means deposits and other cash. Get your head around that. $1.6 trillion. People out there, you got too much money in the bank. Lloyds Bank, there's another evil banker on the left. 24 pence purchase price, and today's price is 55 pence. And I believe we exited at 75p many moons ago. So not a bad buy and hold, 129%, but better to have exited at the 75p. Then we have Logitech. There's a mouse. Get it? Logitech mouse. Purchase price $77.05. Today's price $97.68. So 87% return on that if you would have bought and hold. Magnite. This is online advertising. $15.30 purchase price. Today's price $13.24. So negative 13% on that one. Too Low Oil. That is not a picture of its one of its own oil gushings, but one I found on the internet. 32 pence purchase price in September 2020, and today the price is 33 pence. So a 3% return over 3.5 years. So not very good, too low. Glad we got out of that one. And finally, Vital Energy, we bought at $18.56, and today's price $42.76. So possible return from buy and hold 130%. So a good one. And then moving on, these are the funds, with Del Boy saying, it makes sense. Here's, by the way, this is a list of the stocks if you want to see them all in one place. And the average, by the way, that portfolio, if you averaged everything together, it was a 19% return over about 3.5 years, all of those stocks together. So, really not good, way behind the markets, way behind the indexes. And it was fun though, and it was good for the video content. But let's go to the funds. Here's the Fundsmith Equity Income Fund that a lot of people, including our emailer who asked the question, there's Terry Smith on the left boxing away. Purchase price £5.25 in September 2020, and today's price £7.18, so 37% buy and hold return for the last 3.5 years. Fundsmith has really been I would say, one of the darlings of the UK actively managed stock funds, but it's not actually done that good, at least over those 3.5 years. Now, if you back test further, I'm sure you'll have different numbers, but again, I'm just looking at when I started this trading 212 portfolio. So 37%, not terrible, not great. And here we go, Vanguard, the US index tracker, the US equity index tracker, of course, one I talk about a lot on the stream. Purchase price September 2020, £551.43. Today's price much higher, £947.53. We've had a total return of 72%, so pretty good for 3.5 years. Very good. There you can see the founder of Vanguard, Jack Bogle, there on the left, dressing like a punk rocker. Pretty cool picture. And finally, the Fidelity World Index Tracker. There is the founder of Fidelity Bank. I can't remember what his name is, but he's there on the left. Purchase price, and this is the UK one, £2.09 back in September 2020, and today the price is £3.41. Total possible return of 63%. So again, another pretty decent return over the 3.5 years. Really not that much difference between the US and the world, but at about 9%. So good, I think, results from both of those. I prefer, obviously, the US, but even so, here's the final results from Del Boy, and that really funny greeting card that I found says, this time next year we'll be millionaires, but you'll be a year older and still a plonker. I don't know why I put that on there. But here's the final results. You can see everything right here. If you'd have bought these three funds together, let's say you didn't want to risk just the US, or you didn't want to do just the world, and you want to do all three of those with the Fundsmith, the US, and the World Tracker, you'd have gotten yourself 57% returns from September 2020 to today of just buying and holding. And the stocks, again, if you'd have bought and hold this little portfolio of, I would say, some heavyweights, some risky stocks, like the Tulo was very risky, Fastly was risky, Aurora Cannabis risky, you would have scored yourself 19%. So perfect example of why the buy and hold works, but it also has to be in the correct investment environment. And there's a lot of people out there who swear by things like these Fundsmith equity income funds and this actively managed funds where they think somebody's better at stock picking because it's an individual doing it, where I say it's the individuals that really make the mistakes. And they're the ones that get it wrong, like I did. I mean, look at this portfolio, 19% over 3 years during one of the biggest bull runs in the stock market. So I got it wrong. And it's better just not to even try to be picking this stuff out, because it's just very, very hard to do so. So I hope you enjoyed that slideshow. Yes. I was going to tell you something else. Oh, let's just take a quick look at the trading 212 portfolio anyway, since we're talking about it. We've had a pretty swingy day today. We were up to almost 22,500 today, but the markets really reversed themselves. So right now we're at 22,085. So trading this portfolio has been good over the long run, but extremely risky and a lot of blind luck. I think everybody could have made money in the last 3 years, and the market's pretty much buying most of the stocks. But you can still see the drag on the portfolio right now is this Rivian stock, which again has lost over the last week 12.51%. Starting to get the gut feeling that pulling the plug on this one might be the way to go. I've also been considering, maybe just making some changes and starting over again, but I also don't want the tax liability of having to pay taxes on some of these gains. So I'm not sure whether that's the right thing to do. We're still sitting on quite a bit of cash, 8,259. That's getting a little bit over 5% interest. Looking for an opportunity you haven't seen yet. But Coinbase has been up and down with the price of Bitcoin. Has been pretty volatile recently, so that stock price has been moving with the price of Bitcoin. But the portfolio still is doing really well from where its starting point was. A couple of interesting things I saw on Twitter today. Rajit Soni tweeted, "Real estate is a terrible investment if you couldn't borrow money to buy homes. People think mortgages are helping them, but in reality, mortgages increase demand for homes. If mortgages were eliminated, I think home prices would drop 80 to 90% because nobody would be able to pay cash at these prices. Mortgages have turned housing, a basic human need, into an investment." And then the first comment down here says, "I'm beginning to think real estate should be illegal. It inflates prices. Then new young families can't afford to buy their first home. The family crumbles and our family values dissipate in our society. I honestly think real estate investing is wrong." Yeah, illegal. I don't think you could make it illegal. But this is a really interesting tweet because the UK really suffers from, number one, housing shortages, and number two, people, you hear about not being able to get onto the property ladder because it is so expensive. And when you think about it, it's really the banks that have caused this issue, because he's right. If mortgages didn't exist, then the house prices wouldn't be shooting up to the rates they were, because there wouldn't be anybody to buy them. Most people wouldn't be able to pay $300,000 in cash for a house or more. Of course, there's that small percentage of society, good luck to you if you're in that position where you could just pay cash for any house, great. But most people can't. And it is funny to think about things in that way, that if mortgages didn't exist, where would house prices really be? What do you think about that? You think mortgages are a good thing or a bad thing? I've never really considered it to be, from that point of view, such a bad thing, but it really, really is. I remember when houses, my dad used to tell me houses would cost £3,000, £4,000, and now look, your average house price is $200,000, $300,000. So maybe eliminations of mortgages would be the ultimate way to get those house prices down. Of course, it'll never happen. It's never going to be a possibility. Mortgages will always exist, but the banks have really created a monster there. And yeah, it's a pretty interesting tweet. Also, MicroStrategy, Michael Saylor, who they would call him Mr. Bitcoin, has just purchased another 11,931 Bitcoins for $786 million from debt. So basically they leveraged convertible notes and they used excess cash that they had, and they have bought another almost 11,931 Bitcoins. So now they hold 226,331 Bitcoins that they paid an average of 36,798 Bitcoins for, worth about 8.3 billion US dollars. So MicroStrategy, this guy is considered to be one of the outlying thinkers of not sitting in cash. He doesn't want any cash in his business, so that business basically just buys Bitcoin with all the excess cash, and any debt they can acquire they turn into cash and then buy Bitcoin. Pretty out there, I would say. Definitely, I mean, he really believes this is the way to go. I don't know what's going to happen in the future. I'm a fan of Bitcoin, but there's no guarantee. I mean, we have to wait and see what happens in the future. But to see this guy paving the way, putting $8.3 billion worth of Bitcoin to his name, and to his company's name, and to his shareholders' names. Because remember, this is a publicly traded company. So the shareholders really believe in what he's doing. And he also says that Bitcoin basically saved his company because they were considering having to sell MicroStrategy. They had a market cap of about $5 billion US, and the business just wasn't working. The cash wasn't helping them, so they turned it into Bitcoin. It saved the company, and now they have a market cap of, I think, $30 billion US. So we'll see in the long run if it works out. Who knows? Hard to say. But I think it's interesting news, if nothing else. The Bitcoin price has taken a bit of a hit. I mean, it's not terrible, 64,800, but some people saw that as a buying opportunity. So it's been down from close to 70,000, and obviously he did too. He saw that as an opportunity up here. Let's see. If we look at the 1 month chart, yeah, we were up at close to 72,000, so definitely a discount. What's that, 10%? Not bad, not bad. I think that's about what I got for you today. Again, I'm feeling a little bit under the weather, so I'm probably going to cut this a little bit short. See if you have any interesting comments. Yeah, drink lots of water. Thank you for the advice. I don't drink enough water. It's one of my things I just forget to do. Thanks for banging on about the Cufflink 10.2%, 10.25% auto invest product. I did put some money in myself a couple of weeks ago, as I showed you. So hopefully that works out. Better late than never. Hi, Dave Dawson. Remember those rate setter snail withdrawal days? They came good in the end. Yes, they did. I bought a few stocks that have gone to zero, part of the risk and learning curve. Yeah. It's not a fun one, though, is it? When you see that stock just going to zero. Imagine those people that had Fastly when it was over $100 and now sits at $6. Not great. George Batchelor, I have a good experience with SoMo. 5,000 minimum for me, which is high. Forces whether regular withdrawal, monthly interest, good recovery on defaulted loans, no capital lost, but lost interest due to one case. If you don't have mortgages, practically no one would be able to buy a house. Are they proposing just renting? I don't think it's by the way, hit that thumbs up if you can. It's very helpful. I don't think they're proposing renting. I think it's really I think it's a play on inflation, really, showing how damaging, number one, inflation and the higher cost of housing and what's happened over the last few years and decades of house prices just getting to be unaffordable, especially for young people nowadays who cannot get into houses unless they have high dual incomes. I think it's a bit of a nod in the direction of alternative investments to beat the rates of rising costs of things and also the rates of inflation. I'm not sure renting is the answer. I think that's kind of throwing your money away in some respects, but I think it's a good point to say that mortgages really destroyed people's ability to be able to afford houses in most cases. So that's all it's saying. It's an interesting theory, which I actually really agree with that. Maybe we have to go communism. I don't know. Joke. Anyway, thanks again to Cufflink. Check them out if you don't have an account. I'll be back next Thursday. Hopefully feeling a little bit better. And I appreciate every single one of you for being here and for listening to me waffle on. I'll be back next week. Hopefully all being well. And there's Harley. She's having a good snooze. So until next time, you guys have a wonderful evening and enjoy your weekend. That is all I got for you. Take care.